Welcome back to the channel, everybody. My name's Max. I appreciate you guys tuning in. Today, I have a really good one for you. Let's talk about my trip to New York and my interview with Mr. Pestrichelli. Mr. Convexity and Mr. Pestrichelli, two old Italian guys. All right. I was invited to a YieldMax event. For those of you that have been following me for a while, that's practically all I talk about, so I'm sure you know that. But for those of you that are new, last month I was invited to a YieldMax event in New York, and YieldMax is kind of one of the big daddies in this alternative, option-based ETF or income high yield, space. They've had a lot of growth, and this was an event that was honoring YieldMax as a brand in New York. Now, as actually the people throwing the party were a group of people named Tidal Financial. Tidal is YieldMax's sponsor. Where Tidal is a white label ETF provider. From what I understand, if you want an ETF, or let's say I want an ETF, I have several good ideas for an ETF. So I want an ETF. I could call up Mike Venuto, the boss down there, or one of his people, and they could set me up with all the regulatory stuff I would need, and the SEC stuff, and the legal and compliance and everything. And if I didn't have a trader, of course, I would be my own trader, right? But if I didn't have my own trader, my ETF, they would hire a sub-advisor, and they would hire someone like Jay and his crew, which is obviously what I would do also if I had an ETF. I would not be the trader. I would be the guy that chose the strategy, but I wouldn't want to be the trader. Okay. So I introduced myself to Mike Venuto. Speaking of Mike, he's a monster in the industry. We spoke for about 5 or 10 minutes, kind of off the record, and I wasn't recording it. But I would really like to get him onto my channel. He's the sub-advisor for a bunch of funds that are really good that I wouldn't mind talking to him about. But also, he had a lot of great general ETF knowledge. Jay said that this guy is a monster in the ETF business and very well respected. All right, so I'm super excited. I was then, and I still am, about the new class of ETFs that have been coming out. The inverse funds. They aren't really inverses. They're actually bearish funds. But for instance, so far we have a bearish Tesla, and it's called CRSH, symbol is CRSH. The TSLY, which is a bullish version of Tesla, does a covered call strategy. So it's long stock or long synthetic, and then a short call, a short out of the money call. Well, CRSH, CRSH, which is based on Tesla, but it's an inverse Tesla. So what they do is they're short stock or synthetic, short put, out of the money put. Anyway, it's just a covered put. It's the exact opposite. In theory, it should be able to monetize a down market or a sideways market. All right, by the time I got a chance to talk with Jay, the schedule was running kind of behind, but we only had a few minutes on camera. We had a panel to go to right after this conversation. Jay even mentioned me by name in the panel because of a small technical correction I made on something he said. We'll watch the panel right after the interview. I'm gonna let the interview roll, then I'll make a comment or two, then we'll let the panel roll, and then I'll come back and we can talk about the conclusions of the conclusions that I drew from the conference. All right. So, I did have an additional chance to talk with Jay at many subjects at dinner. No subject was off limits, and we talked about virtually everything option related. But during this interview, I knew I had a very short amount of time, and there's a certain line of questions, a certain question I wanted to ask Jay. So I was trying to lead him down a path. I think you'll see what I mean. I was kind of going fast, but I'm satisfied with the way it turned out. But I'm really trying to get him to look into running a trade where they own TSLY and CRSH, the two of them together, as a pairs trade, or a call it a fund of funds, but I'd call it a pairs trade. And they keep it delta neutral balanced at all times. They have the expertise to do that. And I think they could do that and give it to the investors in a more tax efficient package than if we tried to do it. All right. Well, that's what I'm going to try to pitch to Jay. So we'll see what he says. Hey guys, this is Max Convexity. I'm here with Jay Pestrichelli. Jay, would you like to introduce yourself and tell us what you do?
I am Jay Pestrichelli, CEO and founder of Zega Financial, but more importantly, we are the portfolio manager for the YieldMax ETFs. Founded the company in 2010. We managed $4.7 billion in assets, and we love options, which is why I think you always connected to us so well.
That is correct. I'm trying to make my niche. My channel is the option education portion of it. But anyway, that brings to my second question. I'm really excited about these inverses because I'm excited about selling covered puts, and because it develops another source of income, and not only that, that other source of income could be a partial hedge. But tell me what. So there's people that are buying half of each and thinking it's gonna. And thinking that's a good idea. Would you say that's a good idea?
Yes, what you're talking about is owning TSLA and owning CRSH, CRSH together.
Correct.
Essentially, without sounding too nerdy, but I think for your channel I can afford to be a little nerdy, essentially you're creating a short iron condor, right? So you're selling the wings, so you're selling a call, you're selling a put, and if the stock stays in a range, great, you earn premium on both sides of that trade. I would say they are an offset to a degree. Certainly they are not fully hedged, right? So, and so where's the risk? So if one of those, both of them are capped directionally, right? So
Correct.
If Tesla shoots one way or another, one of them is going to max out its gain. One of them will have, I don't want to say unlimited, but participation in the losses of about 90%.
Sure.
And so there's a number where it's fine that they move. By the way, since we've launched CRSH, which is, I think is probably just over a month and a couple weeks, Tesla's been sideways. It's almost the perfect environment for that combo of Tesla and CRSH. It won't always be that way. We know this. So I would say they are an offset, right? It's a way to make money regardless of the direction. At least one of them is going to max out on its payment, which is always nice, but it's not riskless. So I think that's a fair way to look at it.
Okay, I do too, and I've been cautioning people on my station the same thing that I've been saying. It's basically like a synthetic strangle, in the sense that one side's going to win every time, or you could call it synthetic straddle. One side's going to win every time, and one side's going to have a loss. But you can have it be possible. Like
I think a strangle actually is a more accurate way to describe it. I think that's better, right? Because you've got the outsides, because you can have this. The loss, I'm picturing your P&L chart, right? It just keeps going down on both sides. Yeah, so I think a short strangle is a better way to describe it.
Yeah, well, so, and the other thing, I think people are putting 50% in each, and I'm going to start on Monday putting the proper hedge ratio out there, and I'm going to consider the volatility of each of them, and I'm going to consider the relative, how would I do that? I'm going to consider the price. I mean, here's what the way a newbie would do it is just take the inverse of the difference in the prices. If one's trading at 20 and one's trading at 15, you put 100 shares in the one trading at 15, and then whatever in the one
75 of the one trading at 20.
Exactly, yeah.
So I would say invest dollars.
Yeah.
You've just said equal dollars onto both sides.
Yeah.
I think that makes sense. I would, even if you want to get more sophisticated, even look at, say, hey, are one of these deep in the money, and what's the upside participation on each one? So if you wanted to get really active on it, and I'm not recommending that, but if you really wanted to nail down, you would delta weight them.
Well, that's why I asked you that, because I wanted an idea, and that's what I'm going to do.
Yeah.
That's the right way to do it.
I
want to know how a professional would do it.
Yeah, I would delta weight them, which means look at the rate of change of each one of those, compare them to each other, and you want to keep those equal, which would mean adding a few shares to one as it's moving in the direction where you need to add more deltas.
So it means rebalance. So you guys call that rebalancing.
Rebalancing, but I wouldn't change the whole bit. It would be more like, I would rebalance the delta.
Okay.
So let's say Tesla. So what does that mean? If Tesla goes up, what happens to my delta on TSLA? It starts to go down, right? Because it goes closer and closer, and even in the money. Okay, now I need to have more shares to get the same amount of movement. And then in that scenario, CRSH's delta would go the other way, right? So just probably either adding shares here or taking shares off CRSH. So yeah, I would say watch the delta on those if you really want to do it like what if you truly were going to want to keep this thing as
like
neutral as possible.
As neutral as possible.
Yeah, and that's what a market maker will do, right? That's
sure.
what the house does.
Exactly.
Yeah.
That's always I'm trying to trade like the house. A lot of people that sell options are trying to trade like the house, even though it's not exactly. It's kind of a
right.
You're kind of taking. So anyway, okay. Well, so now that brings me to my next question. So you obviously have the expertise. You know how to do this. So why don't you guys put a fund together called Cake? Make it half TSLA and half Crash, not half Delta weighted. Rebalance it yourself. You guys do it. Because if I do it once, so let's say I rebalance every Friday, doesn't it create taxable event? Is it if I'm buying it, selling all the time to keep it in the perfect way? Wouldn't that be a problem?
Look, I would say in general, the YieldMax strategies are not the most tax efficient. Yes, there are times where we have return of capital. We've talked about that in the past. I've covered that in the past. So I would say, generally speaking, with YieldMax anyway, we see the behavior of a lot of YieldMax investors where they're kind of bouncing or they're rebouncing on their own anyway. So yes, a consideration, but I would say like it's probably already a problem.
I got you.
The other, why wouldn't we come up with Cake? That's a good first time anybody's asked one versus the other, and us manage that pair. That would be interesting.
Okay, well, so I have a.
Why Cake? Did I miss the Cake reference for Tesla?
Well,
because
have
your cake and eat it.
Had your cake and eat it too.
Okay, I was like, okay,
well,
got it.
I have a better one. So, so you're still dealing with one underlying. Even if you did the Cake theory, you could still have one side get blown out. One day you might be down 2% in one, and you might only make 0.5% in the other.
Sure.
And you're going to have a big 1.5% loss on a theoretically riskless or lower type risk trade, but it isn't. Okay, the balancing of the right proportions will help a little bit with that. What would really help is if you guys would do this on Alti, make an inverse Alti where you had 15 of these things, and then you ran the inverse at the same time. So you have Alti and you have Salty. And then rebalance it. All I want, Jay, I don't know why this is so hard. All I want is to make income. I want a fixed income investment that where the NAV just goes like this.
With reduced underlying risk. That's what you're looking for.
Yeah, I want as low as possible. So that's what I think investors try to do that themselves by taking part of the dividends and reinvesting, dollar cost averaging down. You know, everyone says the dividend's too high. Well, you don't have to take the whole thing. You can reinvest a portion of it.
I think
that lowers your average cost.
I think you should too.
And I do too. But I just think on Alti, when you have 15 underlines, that would take the problem away of having it would make the average results better. Because even if you have one blowout, you have 14 others.
Yep. So we are absolutely looking to do more inverse work. Okay. Inverse Alti is absolutely in the discussion.
What about inverse YieldMax?
Well, we only have one inverse today, so once we had multiple and do the fund of funds, then I think an inverse YieldMax would absolutely make sense.
But you've thought about an inverse Alti. I think that would be I think that would be huge, and then I would prefer it if you guys would delta neutral it. But you're right, investors could do it themselves also, and And
it doesn't have to be as complicated as I made it with it's like, look, put the same amount of dollars into each one of them, and if you're you're gonna have to reinvest once a month anyway when you get the distributions, reinvest at that.
So you think once a month is enough on the rebalance?
I think it probably is. Again, it depends on the underlying, but it's probably okay.
Okay. Well, I'm going to start producing more content that deals with hedging and that kind of stuff.
I think showing that pair is a really great idea.
I appreciate that. Well, we have limited time today, everybody. But I appreciate you for inviting us here to New York. It's great. I've learned a lot. I'm sure we're going to learn a lot more. We're getting ready to have a panel, and we're looking forward to it. But I really appreciate it, Jay.
I'm so glad you're here. I'm glad you're going to get to have this experience with us.
It's been wonderful.
I've always looked at the New York Stock Exchange a little bit as our financial beacon. Like, okay, can we get to the NYSE? Can we get to the New York Stock Exchange? So should be a great time today.
It's the big leagues.
This
is also the greatest country in the history of the world and the greatest economic miracle that happened in this building. There's never been more wealth created, and probably never will be.
No, center of capitalism right here.
Center of capitalism.
Absolutely.
Well, Jay, it's been great talking to you.
Thanks so much.
Thank you again. All right. Well, first I just wanted to say I said I was trying to make my niche option strategy education. I can't even remember my own niche. It's the strategy. That's my niche. All right. Let's listen to this panel, and then I'll make some remarks, and we'll kind of wrap things up after that.
All right. So Jay, on the mechanics, I'm going to go to you just for the record, kind of give the YieldMax 101, the short side, the long side, the pairing together concepts, the iron condor that we keep hearing about?
Yeah, so everybody has heard the description of YieldMax. Adrian just touched on it, right? The synthetic long, essentially we're long, and then we sell calls 0 to 15% out of the money. Typically it lands at 5%. Great, everybody here is familiar with that tactic. What is new now, which is what you're alluding to, is the fact now we have long and short, or I'd say bullish and bearish, inverse ETFs. And so the pairing of that is starting to become a little interesting. That was always our hope, that people would understand that, hey, having an inverse can, limit some risk, but we're essentially creating, and I'm going to thank Max for straightening me out on this one, a short strangle, right? A short strangle. So, the market stays in a range and you should generate net positive premium. If it moves dramatically one way or the other, then you could still have the losses. And the dynamic of that is, let's say, for example, TSLY is capped on the upside. So you'll make some money. At some point, you stop making money. We all know that's a standard covered call. But the inverse crash, which is a covered put, continues to lose money as the market goes up, right? So while you have this period where they offset, then there's a period where they're neutral, and then there's a period where actually your net loss occurs. However, putting those two together has been always our hope that folks figure it out. Now I don't have to be so biased on the direction of the underlying. And so the inverses, I believe, are going to be the focus of our next few launches. We haven't announced those yet, so I'd say keep an eye out for that. But I think everyone knows we filed for an inverse coin, which is fiat, and inverse NVIDIA, which is dips, chips and dips. Where's Gavin? Have to give him credit for that one. Did he leave already? We have an inverse index one, actually on the Qs, which is the first time we'll have an index version, Apple and ARC. So I would say keep an eye out for those, and we like the way that pairing can work in the products together. The mechanics of that, I think everybody will start to see that as they put them together. I think it's an interesting approach. It's what we're trying to do, continue to be innovative.
Right, and I think the key thing, and I've talked to some of you about this, is the direction is your job to figure out, right? Like, you're the investors who are choosing it, right? If you think that Tesla is going to go flat for a long time, owning both makes a lot of sense. If you think Tesla's going to go up, own Tesla. If you think Tesla's going to go down, own Crash. There is no set it and forget it and be done with this. You got to continue to do the work. And you guys have chosen to find your own financial independence. A lot of people have historically relied on brokers and advisors to do this for you. They're not getting educated here like you folks are. You guys are doing the work. But if you're going to use the pair, know that you're making a bet that the thing's going sideways. Otherwise, make a bet on what you believe it's going to do. And to that end, I think Bell's got our back. All right, Jay, I'm giving you the last formal question, and then we'll try and get to the audience. We've had so much happen in such a short amount of time. What are you most excited about? Is it the Ulti-like products? Is it the fund to funds? Is it the shorts? Is it just the next names? What are you most excited about in the YieldMax suite?
Yeah, it's actually almost like this realization finally that the investing community is embracing options the way that they are, right? Well, of course, I think we have put out great products, innovative products, and there's so much more on the back burner that if you guys have talked to some of the other people in this room, you may get hints here and there of what's coming. But for me, the thing that's actually most exciting is that the world can see options can be used for long-term investing, that options can be an enhancement. Options are not just speculating on if a stock's going to beat earnings or not and how to profit from that. Yes, of course, that's always the fun thing to watch on Fast Money. But for me, when I started my firm, it was about letting the community know, letting the investing community, there's a better way to invest and we can do it with options. To me, finally seeing that happen is important. Like our advisor business is fine. We've had growth there, but it's this kind of wave, tidal wave, literally, of what's happening in this space that's exciting me the most. The fact that the world is embracing options is number one thing I'm trying to get done, and it's happening. So thank you, Mike.
Wonderful. All right, we got time for one or two questions. Anybody have anything? If not, I've got some ahead of time, so you did. Okay.
So, what can YieldMax or Tidal or anyone do? I don't know.
Yeah, I mean, this is a good question, and it's, I was praising regulators earlier for making it easier for us to bring products out like this. They have not made it easier for us to communicate about them. So that honestly, the best thing we can do to help educate is go on your shows, right? Because in order to explain this in depth, we have to put so much disclosure on it that nobody will ever read it. So there is this attempt by regulators to protect that often goes the other way. And that's why communities like yours are so important, and why everybody up here is happy to talk to the community and answer questions and explain the things that we've learned investing in these spaces for 30 years. There are good actual non-regulatory bodies like the OCC. They do put out some good stuff. They will help. But even there, they can only go so far, right? Like our country definitely suffers from a lack of financial literacy and education. Right. This stuff should be taught in school. I was talking to our son the other day, and he asked me, how do you know this stuff? Where did they teach this to you? And it's like, they don't teach this to you almost anywhere. So what you folks do is super important to that end.
I just love how Jay said that his main goal is just bringing, options mainstream, and people see that they can be used for serious long-term retirement purposes and, estate planning, and not just YOLOing. Now, I'm paraphrasing what he said a little bit, but of course I really like that. Okay. All right. So my takeaways from the conference, these guys are first ultra responsive to what we need as investors. I privately lobby Jay often for new strategies. I'm sure he just loves when people like me, retail traders, call him and tell him what to do. But he does listen is the point. He takes suggestions. Other people do as well, make suggestions to him. And I believe he listens to our input. Spy T, I believe, was partly because of community input. Jay didn't say this, but I think JEPY is too risky for some traders. Spy T was a less risky version of these types of funds. And I think they heard the people talking, and that's why they made Spy T. So what Spy T is functionally, instead of a covered call fund, it's a covered call spread fund. It's a very small distinction. Let's look at it just real quick. I promise this won't take but just a second. Okay, so this right here is the profit and loss graph of a covered call, of your standard covered call. All right. So you can see if we sold this 265 call, you could sell it for about $278 right now. Sure enough, I wonder if the market doesn't move. The go nowhere price is what, $278, because that's what you could sell the option for. Anyway, that's your amount of buffer. But then you can still profit. This is an in the money option. The market for Tesla is only at 252 or something. This option's at 265. So you have the chance to have your NAV appreciate of your investment all the way up to 265. Then you're kept out. All right, perfect. We've seen covered calls a million times. Easy peasy. All a covered call spread is, simplest thing in the world. You add a call above the other call. Okay, in Spy T and in Spy T they use 15-point strike. So we're just going to say, for the sake of argument, but in Tesla we'll use a 15-point strike. So in other words, that means a 15-point strike. That means there's 15 points of risk in this trade, because what will happen is this trade will be capped out between the prices of 265 and 280. Then above 280, this trade will be uncapped. So if Tesla has an outlier, move, and they move up, 16%, it's worth $2,700 a contract. So the only drawback to this is instead of getting $278 for $280 just for selling this one, you have to buy this call, this out of the money call, and it cuts into your profits. It costs about $90. So you really only you cut into the income that you're able to make with this trade. So there are other funds out there that, like SPY, that have it in their prospectus. They can use call spreads instead of covered calls, but to my knowledge, none of them have used it yet. This is the first widespread implementation of call spreads, and it's a genius idea because it does partially uncap the upside. Which to me is a big problem, the capped upside. So, to each his own though. So what I'm trying to get Jay to release next, you heard me mention inverse ALTI. Okay, that would be great. So this means the ETF would short all of the ALTI stocks. Okay, now, I'm not bearish on the ALTI stocks, but I think it would be, I would like to run the ALTI and the short ALTI together. I think that would be a natural, and you could collect big distributions on both sides, from the puts, from the IV off the puts and the IV off the calls. So Jay also mentioned an inverse triple Qs. Now I've been privately mentioning or lobbying him for that ever since I first met him. That's going to be huge. Now this is going to be a YieldMax fund. I was a little surprised this wasn't the Defiance product, the inverse NASDAQ fund, but in any event, that's going to be huge. That is really exciting. So inverse ALTI is based on 15 or 20 stocks, inverse triple Qs based on 100 stocks. So this would prevent or dampen the problem that's happening with TSLY and CRSH lately, where they aren't hedging each other off that well because of the outlier, because it's based on one stock. When you do it and you run a strategy like this on an index based on 15 stocks or even 100 stocks, this isn't going to be a problem anymore, in my opinion. Think about this. Can you imagine all the upside that a fund like ULTY and YieldMax leave on the table being fully capped the entire time? Remember, they're selling covered calls. They don't do call spreads yet. I think 20% is way more than enough of a dividend. I see that happening very soon too. And this is also community request, and also something else I've been lobbying for is target funds, where ULTY and YieldMax sell call spreads instead of covered calls. This partially uncaps the upside, just like I showed you in that last demonstration. So the next frontier is definitely target fund ALTI. So you would have, that would be TALTI. So you would have ALTI, TALTI, and SALTI. And then the one I really want is DALTI, and that would be a delta neutral pair that they manage. But he didn't sound interested in doing that. Think about this. Can you imagine something like NVDY? If NVDY had partially uncapped upside, call it NVDT for target, pay 20%. I think single stock target funds would be a home run. Can you imagine how much upside an NVDY could potentially catch if it wrote call spreads instead of covered calls? The next frontier is uncapping the upside. The main knock on these funds, and I just mentioned a second ago, is they don't get enough upside, especially in a runaway bull market. Jay and Sylvia will tell you these are income investments. They aren't designed for upside, which is true. And Warren Buffett and the banks and the insurance companies that do these overwrite strategies, they understand that, but I don't think retail does understand that. I think retail wants an asset with a good chance of capital appreciation and a dividend, but I think the dividend comes second. And I get it, where, it's un-American to invest in something that doesn't maximize capital appreciation. I mean, we're capitalist. Hot dogs, apple pie, Chevrolet, higher stock market. Retail loves upside. Everybody loves a winner. Retail's been conditioned, for better or worse, to prioritize NAV appreciation more so than total return. However, to be fair, until recently, if you pick the investment with the highest NAV appreciation, you also had the one with the highest total return. These high yield ETFs change the math around a little bit. Sometimes you'll see one of these that has a negative NAV return and still a very high total return, competitive with other funds that have positive NAV return. So this is definitely a new paradigm. I will say this at the same time, though, I've never heard anyone say, hey, ULTY doesn't pay a high enough dividend. That 90% is just not enough for me. I think investors would be happy with 20% out of ULTY. Call it a target ULTY, like I said, TULTY, and have a ton of upside, or you'd have the potential to catch upside. The stocks in the fund still have to go up, but you would have that potential because it would be uncapped partially. Think about YieldMax or YMAG, but think about one of those two paying about 20%, but having partially uncapped upside. Think about the stocks that are in the YieldMax universe or the YMAG universe for that matter. Right now they pay about 40, 35 or 40%. Imagine if Jay only paid half, but partially uncapped the upside. Timex. That's exciting. I think all this stuff's very exciting. I'd be interested to know what you guys think. Now, target funds don't solve everything. Of course, the target fund's drawback is it doesn't protect the downside to the same degree a standard covered call fund does, what I would call a full overwrite fund, where they sell a covered call and the upside's totally capped. There's no further chance for appreciation beyond a certain point. So those funds, JEPY, will protect the downside to a better degree in a bear market. All right. However, SPY-T will perform better in a bull market. It will impede the upside less in a bull market. So there's no one size fits all, like my new buddy Mike was saying. It's up to us investors to figure it out. And I'm cool with that. What do you guys think of what Mike and Jay said? So, the main takeaway was, yes, they do listen to us. And then on a personal level, Jay is a really nice guy, and he's the kind of guy that's hands-on and knows everything that's going on with this fund. And he's very in tune with everything that's going on. At dinner, he made sure that everyone that was sitting at the table was happy, and he talked to everybody. He went around and made sure to spend time with everybody. He's a really good people person in addition to being a good money person. So, but yeah, they do listen to us. So the world's our oyster. I think that we were partially responsible for the SPY-T and those type funds, and target alties, or not target alty, inverse alties on the way. And we were partly responsible for inverses, especially in inverse alty. I've really been, and also inverse indexes. Inverse QQQ is going to be huge. That was also part of us. But now, if we get a target fund alty, wonder if we get a target in an inverse. Wonder if they have, anyway, it could get very complicated, and I don't know where they're going to go with this, and I don't know if other people are as interested in target funds as I am. Maybe some people like to get these 60% dividends and then reinvest 2/3. But if you did a target fund and you never even saw that other 2/3, it just stayed in the fund, of course, it'd be way more tax efficient. It'd be easier. So and plus 20% is more than enough dividend for me, for my needs. But I don't know. Let me know what you guys think. I'm not trying to throw wet blanket on the dividend party. I'm all about, hopefully what I'm hoping they'll do is they'll have a target fund version of these, and they'll have a full version of these. So there'll be a SPY-T and a JEPY. And I hope, I don't know that they'll do this. I hope they have the inverse. So like the inverse NASDAQ, they'll have, I don't know what that'll be called, but whatever. I'm really hoping that they also have a target inverse NASDAQ. So it's partially uncapped. You know, that would be huge. That would, I mean, to me, that would be huge. Target funds going both ways. Anyway, all right, guys. Well, let me know what you guys think. You have a great evening, and I will talk to you later.